In August, I forecast a stormy autumn as the US prepared to stop pumping billions of dollars into its economy every month. The US Federal Reserve has not stopped the printing presses just yet, but we have seen big falls in stock markets as investors shiver in anticipation of this easy money disappearing. Since the 1st of August, the FTSE 100 has fallen 4.5%. August was fine, but from 4th of September, the index tumbled 10% before rallying recently. It's the same with the FTSE All-Share, which measures more of the UK stock market. It's down 5% this year. In the city, a 10% fall like we had in September and October is called a correction. It's a euphemism, but the point is it's different from a crash when markets fall 20% and you have a bear market. Fortunately, that's not what we had. The FTSE World Index did the same as the UK, as did the US S&P 500. Europe fell. So did Hong Kong. Japan's decline came later but was fast and furious. Emerging markets have fallen 9% in 3 months. Meanwhile, the oil price has tumbled due to slowing demand and excess supply. This chart shows the flash crash in yields, or the income from US government bonds. That happened because the price of these treasuries soared as investors sought a safe haven. The red October storm has certainly banished complacency. There had been a disturbing calm in markets. That's gone, as you can see from this VIX Fear Index, which measures the volatility or how much markets jump up and down. The recent spike in volatility is nothing compared to the financial crisis and the Eurozone crisis 3 years later. So what's happened this time? All it took was the International Monetary Fund to trim its forecasts of world growth for this year and next. World growth is mediocre and a bit worse than forecast in July, it said this month. This statement crystallised concerns over how weak the world economy looked, given how much funny money central banks in the UK, US and Japan had chucked into stimulating activity. Inflation in the UK, US and especially Europe has fallen. While that's good for consumers, it means economies are not motoring. So what's the weather forecast now? Broadly speaking, shares look better value after the declines, but investors have lowered their expectations for how much money they'll make in future. If economic growth is slow, then company profits won't be as high as forecast. So expect more volatility as markets continue to guess when interest rates will rise. The latest expectation is that UK and US interest rates won't rise until the middle of next year. That gives bonds a stay of execution as many fixed interest stocks suffer when interest rates rise. The UK economy is doing quite well, but uncertainty over who will be in power after the election in May could hurt the pound, making the UK stock market less attractive to international investors. The US economy is also doing well. That's boosting the dollar, which will be tricky for emerging markets if US investors disinvest and bring their money home. Europe is in a mess, but its stock markets are cheap. The best hope is that the European Central Bank finally follows the money printing policies of the UK and US to avoid a slump. In Japan, we should see more of this quantitative easing as the government seeks to reflate its depressed economy. The wild card is China. If you believe its data, it's managing a gradual slowdown in its imbalanced economy, but an accident could happen there. As before, nobody, least of all me, knows what will happen with the weather. The best way to cope with stock market squalls is to spread your money around. As ever, don't put all your eggs in one basket.